He walked barefoot into Wall Street boardrooms. He mandated morning meetings and immediately started pouring shots of tequila. Yet, despite this blatant lack of professionalism, Adam Neumann convinced the smartest investors on Earth his office space rental company was a tech unicorn worth $47 billion. When the math finally caught up and the entire empire collapsed, the employees who built the company were left with absolutely nothing. The founder who burned it down walked away with $1 billion. In the late 2010s, private markets were flooded with venture capital. Investors were sitting on mountains of cash, desperate to find the next visionary founder who could scale a company globally. The financial ecosystem had completely abandoned mathematical reality to fund pure charisma. WeWork was the exact illusion Wall Street was begging to buy. Beneath the hype, WeWork was a traditional, boring landlord. They rented floors in commercial buildings, added trendy furniture, installed a neon sign, and subleased the space at a markup. This timeline reveals their dangerous unit economics. WeWork locked itself into expensive 15-year leases. To pay that debt, they sold volatile month-to-month memberships. If the economy dips, freelancers cancel, revenue vanishes, leaving WeWork trapped paying billions for empty buildings. Neumann disguised this catastrophic liability by adopting the language of software. He claimed WeWork was a physical social network that could scale infinitely, securing astronomical tech valuations. By slapping a tech label onto an asset-heavy trap, WeWork completely bypassed standard risk assessment models. Extreme fear of missing out drove venture capital to demand explosive scale over actual profitability. SoftBank and founder Masayoshi Son saw Neumann's energy and wrote checks for billions of dollars. With an unlimited influx of cash, corporate spending spiraled out of control. Neumann bought wave pools, invested in a wave-making company, and purchased a $60 million private jet. The velocity of their burn rate was staggering. The company was destroying its capital reserves to project the illusion of hypergrowth. To legally hide these massive losses from investors, WeWork invented an entirely fictional accounting metric. They called it community-adjusted EBITDA. This mirrors Enron's use of mark-to-market accounting, a tactic used to count future, entirely imaginary profits on 10-year deals that hadn't even happened yet. Faking it until you make it functions perfectly as long as the influx of private hype outpaces the necessity to prove a verifiable profit. The music stopped in 2019. WeWork decided to go public and filed their S-1 paperwork. This legal filing forced them to open their unadjusted, highly regulated books to the world. Public market investors and regulators ignored the fake metrics and looked directly at the cash flow. They realized the company was hemorrhaging billions of dollars. This graph tracks the immediate implosion. Within weeks, the IPO was canceled, the cash reserves dried up, and the $47 billion valuation plummeted to zero. Private market illusions, no matter how heavily subsidized by venture capital, collapse upon contact with public market regulatory math. When the empire fell, a primary investor bailed out the architect of the disaster. SoftBank paid Adam Neumann a golden parachute worth over $1 billion simply to walk away. Thousands of regular WeWork employees lost their jobs. The stock options they accepted instead of higher salaries became totally worthless overnight. We saw the exact same structure in the 2008 financial crisis. The architects of financial collapse are insulated from the blast, while average workers absorb the entirety of the damage. In modern corporate finance, if you build a small failure, you go bankrupt. If you orchestrate a $47 billion illusion, the system rewards you with generational wealth.